Everyone thinks that if you get a reverse mortgage, the bank takes your house, but that's not really how it works. It's actually really fascinating to me as a licensed mortgage professional. Reverse mortgages will come up in conversation and people will immediately balk at them or act disgusted, but when I press them on why, almost no one has a reason or even knows someone with a reverse mortgage. Now, honestly, I understand why people have the response they do, because on the surface it does sound like you're giving up your home in exchange for money, but that's not what's happening. So let me walk you through how these things actually work, how they used to work, what happens when you get one, and then you'll have all the information you need to determine whether or not this is something that you'd like to explore for yourself. Most people hear reverse mortgage and assume it means you're signing the house over to the bank, or that at some point the bank will just show up and take the home whether you're ready for it or not. And that idea has been around for years, and a lot of it comes from older versions of these loans and just bad information. Now, specifically, Congress made some really big changes to how reverse mortgages work in the years following the '08 crisis. Now, most notably, the big changes happened between 2013 and 2015. I'll cover those a bit later. But let's clear things up by looking at how these things actually work in today's world and why financial planners have started to recommend them increasingly to their clients as a tool for retirement planning. Now, when you get a reverse mortgage, you still own your home. Your name stays on the title. Just like with a normal mortgage, what happens is the lender places a lien against the property. That's it. So if you already have a forward mortgage before you get a reverse mortgage, one lien just replaces the other. The reverse mortgage pays off the forward mortgage. You still maintain ownership. What changes is just who has the right to repossess the home if you default on the loan. Now, also, more specifically, how you default on the loan changes, because these things do function differently than a forward mortgage. With a traditional forward mortgage, you make a monthly payment to the lender, gradually reducing the principal balance you owe over time. If you stop doing that on a forward mortgage, you are in default, and the lender can take action to protect themselves, specifically foreclosing on the home. But with a reverse mortgage, you don't have a required monthly mortgage payment. Now, you can still make payments if you like, and many people do, but you're under no obligation to do so. Instead, money that you take from the equity of the home, coupled with the interest rate on the outstanding balance, will accrue over time, gradually increasing the underlying principal balance of the loan. So the reverse part is really about the direction of cash flow, or the direction the loan balance goes, up versus down over time, not about who owns the home. So how does this actually play out over time? Well, in most cases, the loan balance will grow. The exception to this is if you continue to make payments towards the loan balance, you can keep your loan balance the same or even have it decrease over time. Now, you don't have to do this, which is one of the best features of these loans, but many people decide they do want to stay on top of the loan balance, so they continue to pay. Some people will treat their reverse mortgage like it's a forward mortgage, and they'll continue to make payments every single month, while others will just send checks in whenever they have some extra money available. In either case, the nice thing is that you do not have to. If life throws you a curveball and you can't afford to make a payment on the mortgage for a month or 3 months or ever again, that's 100% okay. Now, for all the people that have negative opinions on reverse mortgages, I encourage them to go find another financial product on the market that gives you that kind of flexibility. And while all of this is going on, you're still living in the home, and you still benefit from appreciation of the property. You still have all the rights of ownership. You can sell the home whenever you want. You can refinance the loan if you want to get out from the reverse mortgage. You are not locked into this thing. The only things you must do if you have a reverse mortgage are stay up to date on your property taxes, stay up to date on your homeowner's insurance, stay up to date on your HOA dues if applicable, and stay up to date on the condition of the home. So don't let it fall into disrepair. This is just general home maintenance stuff. Now, here's the part that people are usually most concerned about. If I don't have to make payments on this thing, how does the lender recoup their investment? If that loan balance is going up and up and up, what actually happens when it's time to pay the balance? Well, there are several options and none of them are really complicated, so I'll walk through them for you. Now, we're going to specifically look at the home equity conversion mortgage for this, as they're the most common type of reverse mortgage out there today. They're commonly known as the HECM. First off, let's look at what events trigger this type of loan to become repayable. There is generally no term on these loans, so whether you have the reverse mortgage for 5 years or 50 years really doesn't matter. What matters is when specific events occur that trigger repayment. These events are the last borrower dies, the last borrower moves out of the home, the borrowers fail to stay up to date on that taxes, insurance, or HOA, or you let the home fall into disrepair. So the things I listed just a second ago. Now, if any of these events occur, it will trigger the loan to become payable and due. Once this happens, the borrowers or the estate, if the borrowers have passed, will have 6 months to repay the loan. The borrowers or the estate can request up to 2 90-day extensions, bringing the total repayment timeline up to 12 months. Now, how do you actually repay this? Well, there's a few options. Option 1, pay the loan off. If you or your estate have cash laying around, you can just pay the balance. Not very common, but you can do that. Option 2, sell the home. This is the most common. Almost all HECM reverse mortgages originated after 2016 will have more equity in the home than they owe on the reverse mortgage. So you or the estate can sell the home, use the proceeds to pay off the reverse mortgage, and then keep whatever's left if there is any. Option 3, refinance the loan. So you or your estate can refinance the reverse mortgage into a forward mortgage. You or the estate would obviously have to qualify for said forward mortgage, and you would go back to then being required to make regular monthly mortgage payments, but the new forward mortgage would be used to pay off the balance on the reverse mortgage. And then option 4, just mail the keys in. Now, this actually happens with these loans. It's kind of unique. The HECM reverse mortgages are what's called non-recourse loans. So what that means is that even if the loan balance is higher than the value of the property itself, the lender cannot come after you or your heirs or your estate for the overage. The most they can do is take the house. So if your reverse mortgage does get to the point that there's not equity left in the home, or even if you're upside down on it and you owe more than the home's worth, you or your estate can literally mail the keys in and walk away free and clear. Now, this is mostly thanks to the fact that the HECM reverse mortgage is actually federally insured by the Federal Housing Authority, the FHA. So lenders have protection from losses that may arise from situations like this. Now, I do want to be clear because this is really important. There are absolutely situations where someone could lose the home, just like with any mortgage. If you as the borrower fail to stay up on those things I listed, the taxes, insurance, HOA, and the condition of the home, the lender does have the right to foreclose on the home to recoup their loss. Same idea as a regular mortgage. The only thing that's different is when this happens, what triggers it to happen. So while you don't have a required mortgage payment, you still have responsibilities as the homeowner. Now, one of the biggest things that Congress changed with these loans around 2015 is that lenders now have to do an actual assessment of whether or not they believe you'll be able to stay up to date on your taxes and insurance. In the past, they wouldn't really look at that and validate it. They would just write the loan and give you the money. And then people would default by not paying their taxes and insurance. Now they actually have to run a check on your financial profile to determine the likelihood that you will stay up to date on taxes, insurance, and HOA. So if your situation is dire, they may reject the loan outright. Now, if it's mildly concerning or they find some things that raise concerns, like you co-signed on a loan with someone and then they missed a payment, they may approve the loan with what's called a LESA or an LESA, or a life expectancy set-aside. LESAs can be mandatory or voluntary, but basically all they are is a portion of the money you'd get from the proceeds of the loan are set aside and earmarked for taxes and insurance. So it's basically like an escrow account on a forward mortgage. So today's lenders are required by law to do their due diligence on you when they originate a reverse mortgage. If you don't fit the mold, they either won't lend to you or they'll put some guardrails in place to protect them and to protect you. So who are these for? Well, reverse mortgages are designed for homeowners typically 62 years and older who want access to equity without taking on a monthly payment. They just want to get rid of their mortgage payment in general, and or they want to open a growing line of credit so they can maintain flexibility in later years. And for the right person, these loans can be an incredible tool. But if you're someone who has a history of overspending, building up debt, finding yourself in tight financial positions, then a reverse mortgage may not be an ideal tool for you. Now, I do still tell people that even if you're not a great fit for reverse mortgage, but the alternative option is losing your home, it might still be the right option. Ultimately, everyone's situation is unique, and anyone who is considering a reverse mortgage, I encourage you, please speak with a professional loan originator and honestly, a financial advisor as well to find out what makes the most sense for your specific situation. Now, overall, one of the biggest misconceptions with reverse mortgages is that this idea that the bank just takes your home as a part of the process. And again, it's not how it works. You still own your home. You still have control. And like anything in mortgages, it really comes down to understanding how these things work, the structure of these tools before you make a decision. If you have any questions about whether this could make sense for your personal situation, please feel free to reach out to me. You can use the link in the description below to book some time for a call with me, or you can leave a comment in the video. I'm always happy to chat. Either way, thank you so much for watching this video, and please don't hesitate to like, subscribe, and share this with people that you think might find value out of it and help me reach more people with helpful mortgage tips like this. So until next time, take care.